What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is May 28th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, we're going to be talking about a topic that I feel is not only very important in regards to understanding Bitcoin fundamentally, but also I feel a lot of people miss out on when they're trying to understand the price potential or, the excitement as to why cryptocurrencies are very important, and that is understanding the underlying changes in the global economy. Now, for those of you out there who keep active with the channel, you all know that I not only am a huge fan of cryptocurrencies, but I also come with a background as a macro trader over the last 6 to 7 years. As a macro trader, you do a few different things. I know it sounds like a very overwhelming term, but a macro trader is actually quite simple. I try to get a big picture view of what's going on the world stage. I like to find emerging trends before they happen, and most importantly, in doing so, I try to find the best place to park my capital or to invest my money to let it not only grow, but also keep it safe and protected, to keep it stable to some degree. So these objectives are very important in understanding a new financial asset like Bitcoin. And in today's video, I want to try to provide that perspective to you all without trying to guesstimate short-term price or anything like that, and really try to present to you why I believe the basket of different changes in the global economy are setting up for Bitcoin to do extremely well. All right, so we've got lots to discuss, guys. I hope you all will enjoy the video, and if you like it, please give a thumbs up, as well as considering subscribing and hitting the bell icon for staying tuned for future videos. But to start off, before we dive into these macro factors, guys, when we take a look at Bitcoin, I talked about in a video not too long ago called How to Simplify Bitcoin Investing, where I talked about the fact that Bitcoin itself is really the world's first non-correlated asset. Now, you can maybe find some other ones out there and things that you could call non-correlated assets, but in this video, I want to focus on why Bitcoin is a non-correlated asset. We talked about in the previous video how a correlated asset is something that's tied to a nationality or some kind of government or authority figure or an economy. So, for example, I used as a reference the US dollar. It's tied to the US government. It's tied to the US economy. If either one of those two factors fail, the US dollar could lose a lot of purchasing power. And, if you had your money in it, you could lose a lot of your savings in a case. It might still show that you have $10,000, but those $10,000 might be worth less. Well, in the case of Bitcoin, Bitcoin is not owned by anyone. It is not tied to any specific government or economy. And because of that, as well as other factors backing Bitcoin, it makes it a financial asset that is great for hedging when fear is high, when volatility and uncertainty is high in other markets. It's a great place for capital to flee to, right? And whereas we've seen in previous cycles of Bitcoin that a lot of the movements in Bitcoin in these kind of major macro cycles where Bitcoin 10x's, 20x's, 40x's, whatever it may be, it tends to be that was due to retail speculation or new people, kind of discovering the emerging possibilities of this technology. But this time around, whether we have started that cycle now or we're about to start that cycle in the next few months or year, I believe the next cycle is going to be done due to, it's going to be caused by a wash of different changes in the global economy that are causing a risk-on narrative to turn into a risk-off narrative. People are going to flee capital from equity markets, from traditional commodities, from bonds, different types of correlated assets. So without further ado, let's go ahead and dive right into the video and take a look at the first thing that we have to talk about. So the first point I'm going to incentivize is that stocks and housing properties, assets in general, are overextended. Now, let me make something very clear here, guys. As you all know, as I mentioned, I've traded in traditional markets. I got my start actually trading stocks. And I have to say, I wasn't bearish like a lot of people. A lot of people have been bearish since back in 2008. I was only bearish starting in 2018, which is pretty much where we've topped out at all three major indices for the last year and a half. But I have to say, more than anything, as much as I am bearish right now, there was a lot of great potential in stocks over the last few years. And in fact, I invested in stocks throughout the majority of the bull run. Now, the reason I changed my tone, though, is because I had a shift in an understanding of the fundamentals. So back then from 2011, when I started investing and getting interested in financial markets, politics, economics, I knew that I could invest in equity safely because I knew that the underlying fundamentals were in support of a bull market. You had things like quantitative easing, which was where the U.S. Central Bank, the Federal Reserve, just kept purchasing financial assets off the open market that were seen as toxic assets back from 2008, as well as U.S. Treasuries. And that buying pressure, in that case, not only boosts those assets up, But along with that, it leaves cash into the economy, back in the hands of banks and different types of individuals in the financial sector who are going to buy up equities that were at a discount, right? Not to mention, interest rates were at near zero. So if you wanted to borrow capital and you knew that the S&P 500 or one of these major indexes in the U.S. economy or some of the well-developed companies out there were going to move up at a certain percentage every year, relative assumption, then you could basically borrow capital on the market for free and go out and buy financial assets. These kind of things prop up U.S. stocks. Not to mention, in the later stage of the cycle, we've had the tax cuts in the United States for corporate tax, which has led companies to be able to buy more of their shares and, pay out more dividends, which attracts investors. But also the repatriation of that tax bill, which allowed for a lot of cash to flow back to the United States for a lower tax payment to the government. So a lot of these things kept up stocks. And the one thing that I want to talk about more than anything, though, is that there's been a lot of different little tools and tricks that we've used to keep up markets over the last year. And as an example for Japan, and we might see something very similar to this in the United States, is the ETF problem. And this is something where the Japanese central bank, or the Bank of Japan, which is their central bank, equivalent to the Federal Reserve in the United States, they have gone about purchasing over 80%, you heard me right, 80% of all existing ETFs in their own economy. So the Nikkei, for example, which is their leading index, it's similar to the Dow Jones, the Nasdaq. It's a basket measurement of how the market's performing by basking a variety of stocks in Japan's markets. The Nikkei has barely been hanging by a thread over the last few years. And even with the Japanese central bank going about buying up all these ETFs, they've caused immense buying pressure. Now, as you all probably know, the central bank can just print money and it can buy up financial assets. So that's exactly what it's been doing. And the U.S. Federal Reserve hasn't even done this. We talk about the Fed being, crazy and being the enemy. But as we can see here, the Japanese central bank has taken it to the next level, whereas the Federal Reserve was buying up U.S. treasuries and buying up toxic assets like the mortgage-backed securities that caused the crash in 2008. We are now seeing the Japanese government buying up direct equities. It doesn't matter if these are, failing companies or companies that aren't making money or anything like that. And they're not providing a little bit of relief. They're providing a ton of relief. They're one of the major stockholders in the vast majority of Japanese companies. So what happens when the central bank is, who prints money out of thin air, who didn't work to produce that capital, owns equity in these companies? It's a very scary scenario. It's very Ponzi-like in a sense. But as we go into talking about, overall markets, as we can see, we'll continue to talk about the changing tones and everything. But my major point here is the first macro factor is that equities have been on an overextended rally, and assets in general. We've been on a bull market. If you even want to consider really even this kind of sideways market here, it's been about a 9 to 10 year period that we've been able to hold since the lows down here in 2009. It's been a fantastic rally. As I said, I invested in a lot of this, guys, but when I start to see markets moving sideways and when I see clear technical patterns like a triple top here on the Dow Jones and a double top on the Nasdaq and the S&P 500, those are clear reversal signs. I'm a macro trader. I trade these cycles. I don't feel comfortable when I see price topping out at the same range multiple times. And this can give a lot of people who are investing in this market, a multi-trillion-dollar equity market, some incentive to want to look elsewhere to park their money. Not to mention, this isn't just the case for U.S. stocks, it's the same case for properties. And property values now are starting to stagnate in their growth. The vast majority of gains in property values have started to slow. We've started to see some of the major cities declining in regards to price. We had some of those $1 million condos in Toronto, in New York City, in Los Angeles, and San Francisco, all the major cities throughout the U.S., Canada, Europe, wherever it may be. London's property market as well. And especially Australia, finally starting to go into bear market territory. They're starting to see major declines. This is just the United States, but if you take a look at some of the broader cities, guys, I don't have the time to dive through every single one. You'll see a declining trend. And people I know who have worked as property managers in Australia for the 30-year bull market that it's been in are finally pulling their cards out. They're done with it. They don't want to be a part of it. And in the U.S., which has been one of the strongest, I think, kind of in regards to property markets coming out of the 2008 recession, it's been doing quite well on the broader sense. We finally started to see a double top, and not to mention as well, this is coming at a time where mortgage rates, this is something that a lot of people don't discuss, where mortgage rates are getting tighter and tighter. And the problem with this is that as mortgage rates need to decline because the open market can't pay 5%, that's how weak the economy is in a lot of cases, because people can't pay for that 5%, the mortgage rate, the rate that the bank will charge for you to take out a 30-year mortgage on a home, has to go down. And this squeezes the bank's margins because they're not only having to lower that rate for the consumer, but along with that, the underlying federal funds rate, which we'll take a look at in just a moment, the cost to borrow capital is coming up as well. So there comes a point where banks can no longer make profits on mortgages, and this rate is forced to go up so long as the central bank is raising those interest rates. So they either have to lower it, which the Federal Reserve seems quite stingent on not doing in order to protect the value of the US dollar, but this also leads to catch-22 for the bank. So again, not good for the banking sector, which can lead again to a compounding effect on the recession territory. But also, if the economy can't even pay 5% on a mortgage, what does that tell you? It tells us a lot of different things. So, we've been talking about assets, being overextended, doing well, and getting to a point where we can't see much growth. And this is coming as well with those changing underlying factors. Remember how I mentioned the quantitative easing and the interest rates boosting up equities? Well, those trends are shifting, my friends. We are seeing, for example, if we take a look at total assets of major central banks, you can see that there's a clear decline, but we can take a look at individual ones. We can take a look at the ECB, the European Central Bank, right? European Central Bank has declined almost about $300 billion in assets as they've cut their quantitative easing program. We've seen the Federal Reserve on a shift, a serious shift and decline in regards to the assets it owns. The People's Bank of China double topping here on their assets and continuing to decline throughout 2019. And then also, you can see the Bank of Japan, which has been probably the most ferocious in regards to its engagement in its own economy. Japan has a long-standing history. If you guys want to understand just how far Japan will go to prop up bubbles, watch The Princes of the Yen. That's a great documentary. But this is a prime example of them continuing the same mistakes of the past, guys. Japan's notorious for it. I love Japan in so many ways, though, but that's the one thing I really dislike about Japan. Not to mention, we can see here as well that the Federal Reserve right now is raising its federal funds rate, and it has, even though it stopped here over the last 2 or 3 months, we have been able to hold rates at these levels, meaning that the Fed is still on the gun-ho position of we're going to keep raising rates, we're going to keep it going. So they do not want to decline rates, and if rates are raising too fast, they'll hold it there, but that still holds a detriment on the economy. Can the economy sustain 2 to 3% interest rates? I really don't believe it, guys. When you start to see auto loan defaults and people as well getting that stingy about a slight increase on mortgage rates, it does show some serious signs about the average consumer. And this isn't just in the United States. We have a worse scenario in the European Union and the Eurozone. In the Eurozone, you have basically 0% interest rates, or in the case of Japan, negative interest rates. I mean, what does this mean for the economy when you're literally getting paid to borrow capital? When you're getting paid, you basically have this scenario where I could have a business where I'm losing money. I could be losing 0.3% on my money, and I'm still able to turn a profit because the loans I'm taking out, I'm actually getting paid for in this case, right? So, and people are basically paying to park their capital in the bank. It doesn't make any sense, right? It's completely, off the grid of reality and common sense. We should never be in a territory of negative interest rates, but this is where central banks are forced to because they're on their last limb. We're seeing one of the greatest monetary experiences, and this isn't just me quoting this. I'm actually someone, for example, I know a lot of people think the Rothschilds run everything in the world. I've done a video talking about the Rothschilds. They are very impactful on the world, but they have a very good root in finance with their family's history. And even one of the major Rothschilds have claimed that this monetary experiment of central banks is one of the most, crazy experiments we've ever had in history. It's very unpredictable. We don't know what this is going to lead to and the problems that are going to lead because of these decisions, right? I can tell you what I do believe it's going to lead to. It's going to lead to currency collapse in the long term, but it's not going to be overnight. And this is going to lead, again, to a lot of people losing trust in these central institutions, whether they understand how it happens or not. They're going to see it when they lose their purchasing power. Next thing here, as we go through the variety of different baskets of factors, one thing that people don't really talk about is the shadow banking crisis in India and China. Now, it's a little more severe I would say, in India, as the article points out here in the Bloomberg piece. On the sense of a scale, it might be bigger in China, but to get more to the point, guys, what is shadow banking? Well, shadow banking is basically banking, but in simple terms, a little less regulated and usually with a little less oversight in this case, meaning with the traditional financial sector, with JP Morgan, Goldman Sachs, Bank of America, Chase, all these major banks in the United States, they are under a little bit more regulatory scrutiny with how they operate. And shadow banking is common in the United States as well. It's been a huge, a huge leader in regards to mortgage loans and a lot of the payday loans that have been going on. And if you want to use that as a kind of analogy, that's very similar to what you've seen in India and China. So without getting too deep into the topic, guys, this has basically been one of the major leaders in capital generation for these economies. And as there's been a crackdown on some of these shadow banks and their operations in India and China, the more they do this, the more it's going to dry up liquidity in these economies. Those risky loans that were being made are no longer going to be made, and businesses who will not be able to get loans from traditional businesses will either have to make do with what they've got or will eventually go bankrupt. And it's going to show that a lot of the phony economic growth will eventually have to retrace, right? So that's just another thing that a lot of people don't talk about. One you've probably heard a lot of, and actually the next two topics we'll talk about, really towards this kind of fourth point here in the sense of macro factors, is global tensions are tightening, meaning that we're starting to see global economies get a little bit more isolated, a little more populous in this case, and we're starting to see some economic wars going on. We're seeing it not only in the growing trade war. Now, as you all know, I've talked on this channel, if you keep active with the daily updates, that I feel that really what this is going to lead to, I don't think this is really going to be that bad for the economy. What I do believe it's going to lead to is the U.S. getting some respect for its intellectual property. It's been a huge violation of China's for years, and I think we're going to have the trade deficit for some time. And the reason I say that is because as much as we love U.S. manufactured, U.S. built, I see people going to Walmart every day. I see people taking the cheaper option. And so long as China, which as a country and as a culture is very effective as an economy, it's very homogenous and it's able to produce, unlike most nations in the world. There's a lot of other cheaper areas to manufacture in Taiwan and a lot of developing areas in Asia. But still, China reigns supreme in that case when it comes to manufacturing. It's something that you can't deny it as a macro trader. It's still one of the optimal places to build and manufacture. That being realized, that's kind of what I think is going to come out of it. And I don't think that this is something to worry about, but it's going to play as a fear factor, guys. This does lead to worries when there's excessive tariffs, when there's tensions growing, when there's the issue with Huawei, and this kind of cat and mouse game between the U.S. and China, as well as really the kind of the West and China in general. Along with that, Brexit. Yeah, I remember back in 2015, summer of 2015, when the Brexit vote came through. I don't always get to keep up with EU politics nowadays, but boy, man, this has been going on for a long time. And worst of all, we just finally had Theresa May abandoning her last-ditch effort to get the EU exit deal in this case. We finally have seen Theresa May step down. It was a very emotional step down for her, and no one's happy at the moment. If you get a general summary, you talk to the people who wanted Brexit to happen, who wanted the EU and the UK to stay as one. This is still going on. And this leads to a lot of questions as to doing business in the UK and business with the European Union and what it means, over the next few years. What is it going to mean for all the partnering countries, right? So no matter where you stand on it, no matter where you stand on the trade wars, well, these are global tension kind of activities that lead to uncertainty, and it leads to capital wanting to flow out of these correlated markets, right? Correlated currencies like the dollar and the euro and the British pound, and also in the equity markets, right? In the S&P 500, the Dow Jones, the FTSE 100, one of the major UK indexes, right? Gets people flowing out money out of these correlated economies. Another thing, currency crises. So we saw back during the summer of 2018, Turkey, Venezuela, Argentina, South Africa, the Philippines, a lot of different countries from different geographical regions, potentially on the point of contagion, where we could have some serious currency crises. Well, Turkey has been a prime example of this, and we've recently seen Turkey has started to lose out more and more to the dollar peg as much as it was gaining after the kind of peak that we saw back in 2018. You're welcome to take a look at some of the charts, guys, and dive a bit deeper, but this has to do with overexposure to US dollar denominated debt, meaning that they, for example, in Turkey, had borrowed debt from the United States. Let's say, just keep it simple, let's say I borrowed $1 million of US debt. But the problem is that it was denominated in dollars, and Turkey's currency in this case was basically had lost out purchasing power to the dollar. And because it's denominated in dollars, if like this, let's say, for example, the Turkish lira drops half of its value, that now $1 million loan is the equivalent of a $2 million loan, because I have to work twice as hard to get enough lira to meet that exchange rate with the dollar, to pay down the loan in that case. So a lot of countries are in this kind of boat. A lot of the ones that are experiencing the currency crisis. But it's just one of many things that have caused this. And when you can have a currency crisis, it weighs down for other economies as well, because one domino falling down, one economy getting on its knees, and kind of being wounded at the moment, does not bode well for exports for a lot of developed economies as well. So it's not a positive thing overall. Now, another thing we need to talk about that has led to kind of some of the currency crisis, but really is one of the last macro factors that's going to hurt a lot of developing economies, is the overglut in supply of crude oil and natural gas. Okay, now this is good for consumers. Okay, this is actually a really good thing. I'm happy to see cheap energy prices as much as the next guy, but we need to talk about how low energy prices is going to hurt developing economies. Developing economies, for the vast majority, end up being export economies initially. They export commodities. That's how they make their money. And until they get, become a developed economy and have developed infrastructure and education and all the kind of standards of a developed economy, they stick to producing commodities. It's just how it works. And not to mention, if you understand the New Confessions of an Economic Hitman, great book that I recommend you all read, that'll explain why a lot of these economies are regulated in a sense to pretty much just being export economies. It's a long story, but the fact of the matter is that in the United States, as of recent, this is something that got little to no reporting. We've practically doubled our reserves for oil in the United States over the last year. We've had major discoveries that some of the major basins in Texas and a lot of the other states of the United States have had huge reserves. And this is not only for oil, it's for natural gas as well. I think it was like a 40 or 60% boost. We talked about this in my recent newsletter back about a month or two ago. And when that comes into play, when the U.S. has already become a major producer, when OPEC has not made serious cuts, when Russia will not back down on its natural gas drilling and exporting, you have extremely cheap prices. And in fact, I'd say that right now, oil and natural gas are overextended. They still are overextended at this moment. And we're just finally starting to see it materialize, that we're going to see a major decline. I think oil over the next few years, going into 2020, is going to go down to 20 to 25 a barrel. I really don't see it, because the global economy is slowing down and you still have this glut in supply. And until you get that cut, and so long as some economies in the OPEC region, some of the OPEC members can produce in this $20 to $30 range, you're going to see price stay there, right? So again, this is where I'm seeing oil go long term, as well as natural gas. If it continues in this this overall decade channel that it's been in, it's going to go down to $1 in this case. That's a big difference from where companies were at just a few months ago, where it was November of 2018 and we were rallying and looking to break out of this channel. This puts weighing pressures on developing economies and on the global economy in general. Alrighty, everyone. So I have rambled on about a bunch of things. We've talked about an overextended asset market. We've talked about central banks changing their monetary policy on the global stage. We've talked about shadow banking. We've talked about global growing tensions in regards to the trade war and the continued discussions on Brexit. We've talked about mixtures of currency crises, and we've talked about as well the overglut in commodities. And as a sign, it could potentially, decline some of these, the growth in some of these emerging economies that need growth now more than ever. So that's it for the video, everyone. I hope you all really appreciated it. And in summary, I think as you all are trying to learn to become better traders and investors, if the best piece of advice I could give you is just to simply continue doing research, don't get caught up in the noise, focus on those macro cycles. If enough of these dominoes start to kick into effect, you see major shifts. And this is going to lead, you don't even need that much capital, guys, to really put some perspective. Bitcoin's at around $150 billion market cap, 150, 160, give or take. And right now we're talking about trillions of dollars locked up in traditional currency markets, trillions of dollars locked up in traditional equities, bonds, and treasuries, commodities in this case that are overextended at the moment, or futures contracts and financial products that are tied to these commodities. You don't need that much pressure to push the open idea of investing in cryptocurrencies. You don't need that much capital to see this thing go parabolic. Have we started that cycle yet? I can't guarantee that, guys, and I can't recommend you guys do anything with your money, but I can tell you all, I'm well exposed into cryptocurrencies. I'm excited for the next few years, and if you thought 20,000 was enough for Bitcoin, I'm just going to say clearly we're just getting started. Anyways, everyone, that's it for the video. Thank you all so much for watching. I hope you all are having a fantastic day wherever you are, but until the next video, thank you all so much for watching, and I'll see you all in the next one. Stay tuned.